Hi, this is Alessio Rastagna, leading trader. I hope you're well. I want to talk to you today about the flash crash that occurred on Friday on the British pound currency and why this could potentially be a long-term buy opportunity for us on the British currency. So in a few moments, I'll talk to you about the trade setup, how to go long on the pound, and also we'll talk about the possible reasons for why the flash crash occurred. But before we go on to that, I just want to give you some context and show you where we are right now in the British pound currency. So you can see that since the most recent peak in the British pound currency, there's the LT Edge short signal, which has worked out beautifully so far. Incredible move down here, as you can see, in the British pound currency. And by the way, if you don't trade currencies, you can also look at the exact same chart on FXB, which is the ETF for the British pound. Okay, so if you don't trade currencies, you can look at FXB, for example. But let me just go back to that British pound chart just for a moment. So there are a couple of things I want to show you. Firstly, if I just bring this back to the lows the British pound made after Brexit, or the Brexit vote, you can see there it is. And one thing you will notice is this. If I just box this move, all right, so let's just put this entire range, this sideways range, in a box like this. All right. And one thing we can do here is click duplicate. So duplicate this box. And very interesting, you will see that in fact, the flash crash that occurred on Friday is almost a symmetrical one-to-one projection of that previous range. This is what is referred to in technical analysis as equal drive or symmetry. So you can see that these moves in the pound are symmetrical in nature, one-to-one almost. And that is important to appreciate when we look at the charts of a market. Now you're probably thinking, so why did the British pound drop like this on Friday? Let me just bring it up a little bit, zoom in. So in fact, you will see, let me just get rid of all these boxes here. One of the possible reasons given here, as you can see, why the British pound dropped from 1.26 to 1.19, almost 1.19, is a 700 tick or 700 pip move in one single day. There have been a number of reasons given for this. Now, if I just go into a lower time frame chart on a 15-minute time frame, so we can zoom in on this. Now, I haven't put any indicators on this chart. I just want to show you on this clean chart what's been happening here. And one possible reason has been given for this particular move in the pound has been, in fact, there are some ridiculous theories out there and some more plausible ones. So let me first start by one of the more ridiculous theories. One particular absurd theory that was put forward for the flash crash was that maybe somebody in the big institutions pressed the wrong sell order. So maybe they accidentally put a larger sell number than they should have done. What's called a fat finger. That is a totally ludicrous and nonsensical argument, let me just say that. The second argument put forward for the flash crash was about something the French president, François Hollande, said on Friday morning, some tough words on Brexit, which may have caused this flash crash. And again, I don't accept that either. I think it's highly unlikely. The more likely and more plausible explanations for this flash crash on Friday is with what is called sell programs. These are computerized sell programs produced by the big institutions, which come into action when markets break certain levels. And I think it's much more likely that those computerized sell programs is what's caused this flash crash here. So now let's talk about why this could be a potentially a good long-term opportunity to go long on the British pound. By the way, if you're saying to yourself right now, and I don't blame you at all for this, if you're saying to yourself right now, Alessio, you must be crazy to even think about going long on the British currency right now, I don't blame you at all for thinking that. Because when you look at a chart like this, it does look pretty scary. And if you've been with us now for many years, you probably know by now that the more difficult a trade looks, the more difficult a trading decision is, the more likely that it's the right decision. In fact, there's an old phrase in trading which says that the right decision is usually the one that is psychologically impossible. And the idea of going long on the British pound, if that sounds or looks psychologically impossible, then that probably is the right decision. Of course, one thing we do need to be aware of and respect is how to manage risk in something like this. So let me show you. This is the 15-minute chart of the British pound, and you can see that this is the lows the British pound made here, just above 1.19 at 1.1941. And you can see this is the next low the British pound made here at 1.2226. So there are two lows that we can actually focus on here on the British pound. And I think it's quite likely the British pound will come back and retest these previous lows. Now, I think a retest of this low here at 1.2226 is much more likely than a retest of these lows down here. But again, I cannot rule out the probability that it might actually come back and retest these lows again. So one way to establish a long position on the British pound is to wait for a retest of this first low here at 1.2226 and then go long with a small 1/4 position here. All right, and I do have to mention and stress this point, a very small position here, because the risk we're taking on this trade is quite large. The stop loss needs to be at least below these lows. The ideal stop loss needs to be below 1.19. Okay, so you can see it's going to be a very large stop loss, and this trade is not going to suit everyone. So if you have a smaller account, then this trade is not going to suit you, because the risk and the potential stop loss we have to place here is going to be too large for your account to sustain. And it's really important, of course, to not ignore the fact that the British pound could come down and retest these previous lows. So if you have a smaller account, what you could do is instead wait for a retest, a potential retest of these previous lows formed here at 1.194. Now, it does not mean necessarily they will come down to retest these lows, but again, we cannot rule that out as a possibility. So just to repeat, traders with a smaller account can wait for a potential retest of these previous lows, stops below 1.19, ideally at 1.189, and let's see if we can get a bounce and a potential rally off these lows from here. Now again, our position size on this trade is going to be very small, but I'm looking to add to this trade if the British pound gets above 1.29. So once the British pound can get above the 1.29 level there, that level of resistance sitting up there, because once we're above the 1.29 level as resistance, that means we're potentially made the right decision on this trade. So again, this trade is not going to suit everyone. It certainly is not going to suit traders with a smaller account, but nonetheless, it is a long-term trade, and therefore a lot of patience is required for this setup to work.